Hi, welcome to this video about intrinsic value of stocks. For value investors and for most investors in general, intrinsic value is probably one of the most common used terms, and yet I believe one of the least understood terms as well. So what I would like to do in this video here is to dive a little bit more into the concept of intrinsic value. So first I'm going to explain what intrinsic value is, why it's so important for value investors or for investors in general. I also talk about the meaning behind the calculation. In many cases I've seen videos where people just throw in numbers into a spreadsheet or into a formula and something comes out, but what is really behind those numbers? Then I'll use some real world examples to illustrate what I've been talking about and finally draw some conclusion. So let's start from the very basic principle of value investing. A value investor starts from the principle that a company or a share of a company has a certain value, and this value will evolve over time. In a typical, I would say ideal scenario, the company will start small, right? And then it will go through a growth phase where typically the value will increase like 20 or 30% per year, and will probably at some point come into a maturity, so market saturation in a maturity phase. It will still grow, but at a lower pace, and probably the company at a time will start paying dividends and so on. This cycle here typically takes a very long time. It's not abnormal to see here like maybe 50 or 100 years for this cycle to happen. The stock market, however, will oscillate quite randomly around this value. So what you will see when you look at the stock prices and the stock market are very much more like random movements of the stock price. At least they look very random. Now, why are these stock prices oscillating? Well, it's because the stock market is not necessarily relating the stock price to the stock value. There are many other factors that play a role in determining the stock price, like sentiment, like emotions, panic, external news, and quite frankly, the stock exchange as a big machine, as a business, is also trying to convince people to sell and buy stocks, because that's actually how they make profit. Now, but for a stock or a value investor, this is a pretty good thing, because sometimes the price of the stock will be higher than the estimated value of the company, then the stock is expensive, and sometimes the stock price might be lower than the value, so then the stock is cheap. So a value investor will typically wait for times when he believes that the stock price is cheap for him to buy the stocks, right? Now, this is a generally used practice for investors, and if you would just here look at a snapshot here of Morningstar. So Morningstar, and if you have a premium account, really gives a pretty good overview and gives it for almost every company out there. So you can see here the red graph shows what they call the fair value. So that's the Morningstar analysts believe is the fair value of that company or that share of the company. And then the black is the price of the share, and you see that it's oscillating and it's moving much more drastically than the red graph. So during the period 2013-2018, Procter & Gamble seemed to be quite cheap, but now lately, as of 2019, with a dip here with the pandemic, but it's actually now quite expensive compared to that. Okay, so now the question is, how can you calculate the value of a company? And one of the most used methodologies for that is to calculate the intrinsic value of the company. That's a concept that has been introduced by Benjamin Graham as an intelligent investor in the 20s last century, and has been used by value investors like Warren Buffett quite extensively later on. So let's hear from Warren Buffett how he would define the intrinsic value of a company.
Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
So let's try to explain what Warren Buffett is telling us here. So let's start from the very conceptual view of a business or an operating company. The core business of an operating company is to deliver products and services to the markets, to the customers, and it will receive money in return. That's the revenue, the sales or the revenue that you typically see as the first item on the income sheet of your financial report. Now, in order to bring the products and services to the market, the company typically has a lot of costs, the operating cost. There is sales cost, there is a production cost, the salaries need to be paid, there's administrative costs, there's a lot of items that need to be paid for the company to be able to deliver its core business. If after paying all of these cost elements, the company is still making money, then the company makes a net profit. Now, in terms of making money for investors, for you as a shareholders, return on investment, we prefer to talk about cash flow. Net profit and cash flow are related, but are certainly not the same things. Free cash flow is considered to be the cash that's left when the company has paid all of the outflow cashes. So it's the cash from operations, and it's called free cash flow because the owners of the company, the board of directors, can freely decide what they're going to do with that cash. All the other cash items, the cost elements, were necessary to run the business, so what's left here is the free cash flow. And the board of directors can decide to do two things with this cash. They could decide to pay it to the shareholders as on just going to their bank account, so as dividend, or they can decide to reinvest a portion or even the entire free cash flow, if they want to, into the company. Now, why would a company do that? The company would reinvest this money into the company, because then without having to submit new shares of the company, it will be able to develop new products, to maybe increase capacity or to penetrate new markets. In other words, it will be able to expand the business. And if the company is able to expand the business, it will also be able to grow their profit. And if the profit grows, well, then the value of the company will also increase. So the point here that's important is that at the end of the day, the cash flow generated by the operating company will always go to the shareholders at the end, either as dividends directly to their bank account, either as market value or value appreciation. So the company will be worth more, so the market, at the time you want to sell or you have to sell your shares, you will likely receive more money for your shares if their value of the company has increased. So at the end of the day, the cash flow, the free cash flow of the company will flow to the shareholders. So Warren Buffett is also talking about the discount rate. So I'll try to illustrate that with a very simple example. So imagine that you would have the opportunity to buy a machine, and this machine is, and use your imagination, is producing $100,000 of cash every single year, year after year after year. However, after 5 years, this machine will be broken, kaput. You'll not be able to fix it again. The question now is, what would be the fair value of this machine? So what would you pay for this machine as an investor? Now, how do you start? Well, the first thing you notice is that this machine will work for 5 years and will produce 5 times $100,000. So you know that it will produce $500,000 in the future. So the first thing you know is that you will never pay more than $500,000 for this machine, because you want to make a return on your investment, so you want to pay less. How much would you pay less? Well, that's really where the discounting factor comes into play. The fact that you have to wait for your money as an investor is costing you money. And let me explain what I mean by that. So let's take the very first year. The first year, after 1 year, you will receive $100,000. You know that. Now, imagine that you would have this $100,000 available right now as an investor. You would be able to probably make money on this. How much? That's really something that you have to make up for yourself. Imagine that you're a pretty good investor and say, look, I expect any investment of mine to produce 10%, so your expected return is 10%. So if you had this $100,000 now, you would have next year, the future value would be $100,000 plus 10%, which would be $110,000. And the formula, very simple, the future value is a present value then, and my $100,000 that I have right now, times 1 plus expected return. Now in the example of our machine here, we have to wait 1 year for that to work, that first slice of $100,000. So we know the future value, it's $100,000. We know the expected return, I want 10%. So the question is now, how much would I pay now in order to get 10% next year? So we know the future value, which is $100,000. We know the expected return. So the present value of that first slice of $100,000 is $90,909. And effectively, if I pay $90,909 now and I receive $100,000 next year, and exactly next year, I will have made 10% return on this slice. I could do the same exercise for the second year. Year 2, I would be able to do the exact same reasoning. Imagine I would have the $100,000 right now. I would make 10% the first year and an additional compounded 10% the second year. So the formula would be that the future value after 2 years would be my present value times 1 plus expected return squared. It's compounded. So let's turn it around again. I know that I will make $100,000 in 2 years from now. So what is it worth today for me if I want to make a 10% compounded annual growth on that investment? Well, it's the future value of 100,000 divided by 1 plus the return squared. So it's $82,645. And effectively, if I invest that amount and I get $100,000 in 2 years from now, I will have made 10% compounded annual growth for my investment. And you can do the same exercise for the 5 slices of $100,000. And if you do that for the full 5 years that the machine will be working, well, you come to a present value of $379,078, right? So at a discount rate of 10%, for a machine that's delivering me 5 years in a row, $100,000, the fair value, which equates to the intrinsic value, because this is a cash flow generated in the future by this machine, is $379,078. Now let's take the exercise a little further. And let's now assume that this machine, the same machine, is still producing $100,000, but it's not stopping after 5 years. It will continue to work like Warren Buffett says, until Judgment Day. So forever and ever. Then the present value, if you just would extrapolate the formula that we used in the previous example, would be the sum of my cash flow divided by 1 plus r, the expected return, to the power of n. So you can really write it in a series. Now, if you would plot that out in Excel, that's what I did here. So you take a cash flow of $100,000. So the first slice you have to pay $90,000. The second slide is a little bit less, and the third slide a little bit less. So if you start to accumulate all of these slices that and the fair value of all of these slices, or the present value of all of these slices, and you accumulate them, you get this graphic here. And you see that the present value, although it has an infinite amount of terms, seems to be converging to a certain value. It seems to be converging to $1 million, right? And why is that? It's simply because after, let's say here, about 40 years, well, it's so long in distance, in time distance, that the amount you have to pay now to get your 10% compounded growth is almost zero. So the numbers, the impact of these slices on the present value will be completely neglectable after, let's say, 40 years. Now, it's actually quite easy to demonstrate that it's 1 million, because if you would just write your equation and your series explicitly, so these are all the terms, it's an infinite number of terms, and you would just multiply both sides of the equation times 1 plus r, then here, of course, 1 plus r is removed, so you get your present value times 1 plus r equals your cash flow plus all of the terms multiplied by 1 plus r. Now, if you look carefully, what you see here between squared brackets is exactly the same as our initial definition of present value. So you can replace the square brackets by present value. And if you do a little bit of equation work here, you see that the present value for this machine that generates a constant cash flow at the end of time, the present value is your cash flow divided by your return. In our case here, cash flow is $100,000, return is 10%, 0.1, dividing by 0.1 is times 10. Indeed, the present value is 1 million. Now let's take it even one additional step further, and let's now imagine, use your imagination, that this machine is not only generating cash for the end until the end of time, but also this cash flow is increasing every year. So we have a very sophisticated machine, a self-learning machine, and the first year it generates my cash flow 100,000 plus 2%, and imagine that the constant growth is 2%. The second year another 2%, so the cash flow would grow with, for instance, 2%. So the formula is pretty much the same as the previous one. So your cash flow, but this time your cash flow will grow by a factor G, also compounding over the years, and you also have still your discount rate here as well. So if you would plot that out, what would be the present value of this machine, or the fair value? Well, if you again use a cash flow, initial cash flow of 100,000, you have a growth rate of 2% and a discount rate of 10%, you see that the present value also here converges to a certain number. It takes more time, but you also see that at the end it will go to a certain amount, and it looks to be a little bit higher than 1.2 million. Can we calculate this? Well, pretty simply, but we can do it pretty much the same as we did in the previous exercise. So if you write the present value explicitly, you then multiply both sides of the equation times 1 plus r, and you divide by 1 plus growth rate. then you get, this first time it becomes the cash plus these terms here between squared bracket. And guess what? Yes, this is also exactly the same term as we found here. So it can replace the square brackets by the present value. And if you do some calculations, the present value equals your initial cash flow times 1 plus growth divided by R, by your discount rate minus the growth. It's important to notice here that your growth rate needs to be smaller than your discount rate if you want this graph to converge. Otherwise, it will become an infinite number. So in our example of our machine, that would mean that the present value is, initial was $100,000, a growth rate of 2% divided by a discount factor of 10% minus 2%, it's $1,275,000. And that's what this line here is converging to, right? So you have seen 3 examples now, 3 scenarios, and we're not done yet because the most important is still to come. If you would now, for these 3 scenarios, take a snapshot after 5 years. So imagine that in scenario 1, you bought this machine. So the machine that made $100,000 in 5 years in a row and then would be broken. You would have invested $379,000, and that's the fair value that we had calculated. What would be the situation, your return on investment after 5 years? Well, this machine will generate 5 times $100,000, right? So it will generate $500,000 after 5 years. The intrinsic value after 5 years of this machine, well, this machine is broken. It will not generate anything anymore, no future cash flow. So the intrinsic value of that machine is 0. So what is your return on investment? Well, you retrieved $500,000. You invested $379,000, so you made a profit of $120,922, which equates to roughly 32%. In the second scenario, remember the machine is generating still $100,000 year after year after year, but it will do it until the end of time. So after 5 years, that machine will also have generated 5 times $100,000, $500,000. However, the intrinsic value after 5 years, well, it's still, formula was intrinsic value equals cash flow divided by discount rate. Now, cash flow is still $100,000. The discount rate is still 10%. Then the intrinsic value actually did not change. So your return on investment is $500,000 at that moment in time, 50%, and it's still running. So it will continue to generate cash for the years to come. Now let's take the third scenario. And this one becomes very interesting. In the third scenario, remember the cash flow is increasing by 2% every year. So we have a constant growth of the cash flow and we have a constant discount rate. After 5 years, since the cash flow is growing, is increasing, you will collect $530,812 of cash. But, and this is really important to notice, the intrinsic value after 5 years will not be the same. It will increase. Why? Because the starting point in your formula is not $100,000 anymore. After 5 years, it will be $110,000 times 1 plus growth, discount rate minus growth. So if you would calculate that, the intrinsic value of your machine will now be $1.4 million, which equates to a 2% compounded annual growth compared to the intrinsic value that you calculated 5 years earlier. So you could even relate that to shares of a company, because you could really consider a company as a cash generating machine. So if you would invest money in a company where the profit is growing year after year after year after year, let's say that the company would grow 10% per year, well, the intrinsic value of that company will also grow 10% every year. That's compounded annual growth of 10% without you having changed anything. So the growth factor remains the same, the discount rate remains the same. So the intrinsic value, right, will increase over time proportionally to the growth of the company. And that's something that a lot of people don't realize. People say the intrinsic value is changing over time. They get that, but they also think it's because the parameters are changing. No, the parameters are exactly the same. The only thing that changes is the fact that your starting point, your starting cash flow is higher. So the intrinsic value also is higher. So not only will a company that has a growth perspective be worth more, because intrinsic value is higher than if it would not be growing, but also it will be growing steadily and intrinsic value will increase over time. Quite important to realize. Okay, so before we go to a real-life example, I would like to still give a conceptual example on how to calculate the intrinsic value for a company. So what you see here is again the very simple and simplistic representation of a company, but I put some numbers in here. So imagine that our operating company here is producing $100,000 of free cash flow every year. Now, one thing we have to bring into the equation here, right, might be a little bit intimidating, but it's extremely important, is the balance sheet. We need to understand how this free cash flow is being funded. And I'll explain why later on. So the balance sheet will typically tell you, right, what the assets are of the company. In this example, for instance, let's say we have a very simple company. It has $500,000 of assets, $450,000 are plant, property and equipment, and $50,000 in cash reserve, right? Now, the funding of these assets was done partially by a bank, by debt, so $200,000 debt from the bank, and $300 was raised by the shareholders. So the company here has sold 1,000 shares of $300, equating to $300,000, right? And you'll see later why this is important. Now, the first thing that the company will have to do with the free cash flow, and it's called free cash flow, but at the end of the day, it's not that arbitrary. The first thing the company will have to do is to pay back the debt. The bank will want to have its money back, so it will have to pay the debt. And now imagine that the debt of $200,000 here will have to be paid back over 5 years. Yeah, every year for the 5 coming years, the company will have to pay back $40,000 of debt to the bank, plus interest, of course, but interest is covered in operating cost. So that's one. What remains there is $60,000 that we call the levered free cash flow. The levered free cash flow for equity. And so it's the free cash flow minus the debt repayment. That's the amount that will flow to the shareholders, either directly through dividends, either by reinvesting in a company. And when free cash flow is reinvested in the company, it goes under the equity. And there's a section there, retained earnings. That's where typically the retained money and earnings will go to. Now, a fourth thing, and just for completeness, that the company could do is use this cash money of $60,000 to buy back shares of the company. Why would a company do that? Well, if it buys back, oh, it's a difficult one. If it buys back shares, the number of shares will decrease, meaning that the company will have to pay less dividend in the future, and the shareholders will be very happy as well because the value of the company will be divided over less shares, so the value per share will increase, so the shareholders will be happy. And the taxation is much lower than for dividend, so a lot of advantages of doing that. Now, how would you calculate the intrinsic value for this company in this example here? So just following Warren Buffett's formula, it's the future cash flow until judgment day divided by the proper discount rate, right? So in our case here, we have to make a few modifications, and there you really see the complexity coming up here. Now imagine that the free cash flow would be a steadily growing cash flow. So the free cash flow would grow by a factor G every year. So it's compounding every year, so it would grow. Now the first thing you see is that we also have to remove the debt repayment. Why is that? Because the free cash flow that you're getting today has already taken the investment of the banks into account. So the banks have invested the money, and you're still paying back the debt, but the free cash flow is already reaping the benefit of that investment of the banks. So one thing that you have to do is to remove that debt from the bank, as we saw in the previous example. And of course, the return, the expected return R or discount factor is the one that you can arbitrarily choose, but we'll talk about that in a minute. So the present value, if you would elaborate a little bit more, after 5 terms, since the debt will be repaid, you can just simply put the rest of the terms into the equation here. Now, of course, you have to count as of 6 because it's a 6th year. But if you would like to bring it back to 1, because it's easier to count, so n equals 1, you can do that. However, 1 plus r to the power of 6. If you want to now do it to the power of 1, you can do that, but then you have to put 1 plus r outside of the summation side here. And this is what you're saying is actually that you're discounting this sum, which sum that starts to look quite familiar. You're discounting this this value here over 5 years. If you also notice that the free cash flow that you have to bring into the equation here is the one of the year before, because you start at year 6. So if you would like to bring it to the first term of the equation, you have to take the one before. It's not 0, but 1, 5. So if you would just replace that formula by the formula that we calculated earlier, the present value is still the 5 terms of the first 5 years plus a finite number now, which is the free cash flow, 1 plus g divided by r minus g, which is typically called the terminal value. So what people typically will do to calculate the intrinsic value of a company, they will write down the first 5 or 10 terms explicitly, because they will estimate the free cash flow as accurately as possible in the 5 first years or the 10 first years, and then they will calculate a terminal value, which is like the further grow. They will estimate like what would be a typical growth, continuous growth rate, typically like 2% or something like that. And then they will also discount that terminal value to the current time. If we do that, if we start a calculation, you put all the numbers in here, we end up with a present value that will equate to $1.1 million. There is still one thing that we have to bring into the equation though. Remember that the company in its assets had $50,000 of cash reserve, you can add that to the present value because it's cash money that you can bring into the equation as well. So the present value is equal to the 1.123 million that we calculated here. We add the $50,000 that we had as cash in our assets, and the total present value is $1,173,369, and we had the 1,000 shares out there, so the value now of the shares is 1,173 per share. Remember that the original shareholders had paid $300 for the shares, so they already made a big profit now just by looking at these numbers here. Okay, one last thing before we dive into some real life examples. In many examples that you'll find on the internet, people are using the WACC as the discount rate. Sounds funny, but it's the weighted average cost of capital. So what's the idea behind the WACC? Well, the idea is that the future cash flow of a company is funded partially by debt. So the banks are giving some money that you have to pay back after, but it's funded by debt, and is partially also funded by shareholders, by equity. So the first thing we're going to do is to make a proportional split between debt and the shareholders' contribution to the company. Debt, you can find it in the balance sheet, and you look for the long-term debt. And the shareholders' participation is and you will really have to look at what the shareholders will invest now, today, in the company. So it is really the actual share price times number of shares, which is the market cap. So that's what the shareholders are contributing to the company today. So the free cash flow of the future will be determined and be funded by debt and by the shareholders. Now let's first look at the debt portion. Now the debt does not come for free. I mean, a bank is okay to provide you money up front, but there will be a cost associated to that, and the cost that the bank will ask you to pay back is the interest. However, and if you would take an income sheet of a financial report, the interest is being deducted from your operating income before the taxes are being paid. And that's important. Why? Because if you would just look, so EBIT, so the earnings before interest and taxes, the net profit is equals the EBIT minus interest. Then you have the EBT times 1 minus taxes. So that's the net profit. So if you rewrite it a little bit, so it's EBIT times 1 minus T minus interest times 1 minus T. So this is the portion that you have to take into your cost as the expected cost. So that's the return that you want absolutely to make for the portion of the debt. That's a return you want to bring into your discount rate. So it's the interest rate, which is typically the absolute number divided by the total debt, times 1 minus tax rate, right? On the shareholder side, right, it's a little bit more complicated. Now, I'll try to explain it in very simple terms. What we have seen is that the intrinsic value of the company is going to evolve with the evolution of the growth of the earnings. If the earnings are growing like 2 or 10 or 15% per year, the intrinsic value of the company will also proportionally evolve over time. However, this can happen in multiple ways. It can be a very smooth ride to follow the intrinsic value, or it can be a very bumpy ride. So what you typically want to do as an investor is say, hey, if it's going to be a smooth ride, I'm okay It's less risky, so I'm okay with less return. But if it's going to be a bumpy ride, so if it's very volatile and I'm not sure where the market will bring me in the future, you probably want to bring in some more buffer, some more risk mitigation. So you're going to try to have a higher return. That's the idea about this formula here. Let me try to explain. So when calculating the cost of equity, you're looking to a term here, beta. And beta, that's the volatility index, or can consider it as a risk factor here. What is beta? Well, beta is calculated looking at 3 years of stock evolution and stock prices, and it's comparing the stock price evolution to the overall market, typically the S&P 500, for instance. So if beta would be 0, that means that there would be no volatility at all. That means that your stock price is smoothly, without any volatility whatsoever, moving following the intrinsic value of your stock. At that moment, it's almost like a long-term bond. There's no risk. I mean, you know that your company will, well, it's 99% chance that your stock will simply evolve according to the intrinsic value. So you don't want to put too much risk factor in there. You're okay there with a risk-free return. And the risk-free return, which is RF, is typically the return of a 10-year government bond in the stock exchange. So it would be close to maybe 1.6 or 2%, right? That would be the minimum return that you would expect if beta would be 0. Now there's no stock out there that has a beta of 0, so it all will have some volatility. But theoretically, if beta would be 0, you would be okay with a risk-free return. If the stock of the last 3 years showed a volatility that's equal to the volatility of the overall market, so overall market like the S&P 500, then beta would be 1. So beta equals 1 means that your stock over the last 3 years have shown the exact same volatility as the overall market. So at that moment in time, you could say that, okay, I also expect the same return as the market. So the market I know is pretty volatile, so I expect the same return as the overall market, which is about 7 to 8%, right? And if beta would be larger than 1, then the stock is even more volatile than the market, while you also expect a bigger return. So if you would put that in a graph, you get this straight line here. And if you would put an equation on this line here, the return on equity equals risk-free plus beta times, this is the average market return minus the risk-free return. Simple check. If beta is 0, then your expected return indeed is risk-free. And if beta is 1, then your expected return is risk-free plus average market minus risk-free, so they cancel each other. So then the expected return is your average market return, right? So this is the calculation of the weighted average cost of capital. Now, a few observations here. You're making quite a lot of assumptions when you're using the WACC as a discount rate. So first of all, you assume that the debt ratio of the company will not change in the future. Well, we know it's not the case. I mean, depending on the interest rates, companies might make more debt, less debt. Also, when they do like a merger, they can also incur more debt. So it's likely not the case. The interest rates and taxes will not change in the future. Yeah. If they change, like for instance, if the interest rate would increase, then all of a sudden your discount rate will also increase. That's also the reason why if people expect inflation, analysts expect inflation, all of a sudden the fair values of the stocks will drop significantly because the interest rates will simply move the discount rate up. The future volatility is the same as the volatility of the past years, which is a very dangerous assumption. I would always say, as an investor, do not project the past into the future. What happened the last 3 years is no guarantee for what will happen in the next 3 years. The risk-free return will not change in the future. You consider a constant risk-free return, let's say of 2%, but it could also be like 3, 4, 5, could go up, also by inflation. So that's also a very, very dangerous assumption. And the average stock market return, is also not changing. So you make a lot of assumptions here using the WACC, where I would say it's a dangerous way to measure the discount rate or to assign a discount rate. My suggestion, and this is typically the way I do it, and I will do that in the examples, is to use a WACC. I calculate a WACC, but I only use it if it's more than 10%. So for me, I'm very conservative. So whenever the WACC is smaller than 10%, I say forget about it. I will use an expected return of 10%. Only if the WACC is higher than 10%, which it's really very, very seldom, but it happens. So it means that the stock is extremely volatile, then I'm okay to use a higher expected return. But I would not use the WACC blindly because it's, in my opinion, there's too many assumptions there and it's very dangerous. So now let's move into some real life examples. Okay, so here is a first real-time example. So this is Google Sheets, by the way, and I love using Google Sheets for my financial reports. So there's a lot of great functionalities. So here, and again, I'm looking to a stock, Procter & Gamble. Now, I know this screen might be a little bit overwhelming, so let me quickly go over what you see here. So here is some information that I gathered directly from the Reuters database. So Procter & Gamble, US dollar, the last price was $142. The beta, as you can see here, 0.42, very low. So Procter & Gamble is really not a very volatile stock. ADR split, that's for, I would say, foreign companies, so don't worry about it. The market cap is about $371 billion. And here are a few things that yellow means assumptions are made. So are things that I put in here. The risk-free return, remember, it's 2%. So I expect risk-free return and 2%. It's actually, I think, might be a little bit lower, but 2% on the safe side. The average market growth is 7%. The weight of debt for Procter & Gamble is almost 8%, and the weight of equity or the shareholders is market is 92%. The interest rate is 1.62%, very low, and tax rate is 23%. That's all calculated from the balance sheets and income sheets of the company. The calculated WACC is 3.90%. As you can see, it's pretty low. As I said before, it's a pretty low return. So because that's no wonder, because it's, as you see, beta is very low. The interest rate is very low, so also you can expect that the WACC is quite low. So I use a discount rate, as I said, of 10%. Right? The debt repayment is $3 billion every year. I always assume that it will be paid back over 10 years. So I just put like a 1/10 of the debt repayment, of the debt, in my equation. So the total debt, we can use a total debt, is about 31 billion. So the debt repayment over 10 years is just an assumption, 3.1 billion. The minimum interest that I expect is 2%. So that's I want to make sure that I don't get here very strange numbers like one-time negative interest and so on. So for me, 2% interest is what I expect. And so the interest rate was 162. I will use 2%. Then the free cash flow 10-year growth, that's simply a very rough estimate. Now, the free cash flow, and I looked at a cash flow here, you can see here, from 2016 to 21, so over the last 5 years, it has incremented by a compounded annual growth of almost 8%. The last 3 years, it was 12%. So 5% is somewhere in the middle, is at the lower end. I would say it's even lower than the 5 years, but it's a pretty conservative calculation again. The perpetual growth is 2%, so that's what typically is being used. So what else do you have here? I will not go into the details on all of the parameters here. Now, let me quickly go, and if you're a little bit familiar with the financial reports of companies, you will see that this is a mix of the income statement, the balance sheet, and the cash flow statement. So you see the revenue of Procter & Gamble. It's the annual reports. You see that it's going up with a compounded annual growth 3% for the last 5 years, 4% for the last 3 years. Now, you can also look at the current year. It's 7% this year for the year to date. So, yeah, which is actually, it's a year report anyway. You see the net income that went up from 10 billion to 14 billion, which is for the last 5 years, 1.6% growth, but see spectacular growth the last 3 years. Very good, strong performance for Procter & Gamble. And your diluted EPS, earnings per share, are also increasing 3% and 26%, pretty much in line with the net income. So they are not changing the amount of shares dramatically. And your free cash flow is also going up, as I said, 8% and 12%. Now, there's a lot of other things I take into account. So there's total debt, there's total equity. So the debt to equity ratio is 0.7 almost, which is pretty decent for a company. You see the stock price has been going up and so on. So anyway, probably we'll spend some more time in the future going all of the elements here. But what's important here? So why did I need to calculate the intrinsic value of the company? I needed the WACC, which I have calculated here based on my parameters here. So 3.9%, which I'll override by 10%. As I said, I don't want to use a low WACC. I don't think that's very safe. The discount rate and then the growth of my free cash flow is 5.19%. And the starting point of my free cash flow is probably going to be somewhere extrapolated. So I extrapolate the last one, and it's probably going to be close to $15 billion. Now, if I would put all this into a formula, and here is my intrinsic value calculation. So the free cash flow, as I said, first year, $15 billion. And then you see it growing. The second year, 16 billion, 17 billion. So it's growing by a rate of 5%, the one that I put in there. Then I put my debt repayment in here. I discount this to get the levered free cash flow, and then discount it to the 10% discount rate. I get here the first year 11 billion, 10 billion. You see the present value of my future cash flow is going down, which is expected, of course. And I also have here a terminal value of $312 billion. No debt after 10 years, so I don't assume any debt there. And the discounted, because I have to do it like of the last of the 5 year, it's $120 billion. So the terminal ratio here, it gives what this value is compared to the entire net present value of the company. So the intrinsic value of this company is nothing else but the sum here of all these elements here. So I take the explicit values of each of the 10 free cash flow estimates, and then I take the terminal value discounted at the proper rate, and I get here to a sum of $217 billion. And I would go back to my initial screen, 227, yeah, right, because I'm still adding the cash to this, which is 10 billion in cash. So I'm adding the cash to that 10 billion. So you come to a net present value of 227 billion US dollars for. Now, the amount of shares there and the total common shares outstanding is 2.4 billion shares. So if you would divide the net present value by the number of shares, you come to an intrinsic value of $87. The current share price is 142, so it is higher. If you would put a margin of safety on top of it, so this is typically 70% that I take, so it would be $61. So through this calculation, you see that in my calculations, Procter & Gamble is pretty expensive. Now, if you remember, I've shown the Morningstar graph in the very beginning. There, the fair value at this moment was $118, so it's much higher than the intrinsic value per share. Now, why is that? It's simply because the calculation parameters could be quite different. For instance, as I said, the calculated WACC is very low, and I use 10%. Now, you could say, well, I don't use 10%. Why not use the market average, 7%? If you do that, boom, your intrinsic value is already 144, right? So if I would pay $144 per share, which is even more expensive what it is today, so to this terms, it is even cheap. So if I expect a return of 7% on my free cash flow every year, I actually would even be in a very correct price now. If I would use even the calculated WACC, just to give you an idea, then all of a sudden the intrinsic value jumps to $400 billion, right? So really, depending on what discount rate you're using, you really see that the calculations of the net present value is really jumping up and down. It's a little less for the free cash flow. So imagine I would say, okay, Procter & Gamble, I don't believe it's going to rise anymore. I'll take 0%. Well, in that case, it's, with a 10% discount, it would be even more expensive. But if I would use like the 7% rate, it's still expensive there. And if I would use the existing 3.9 WACC, it is still decently cheap. So just showing that, and I think it's valuable. It's interesting to play around with the numbers, and the most important reason why it's so important to play around with the numbers is to take a look at what's going on here with the company. But one thing is for sure, that the intrinsic value calculation is absolutely random and is absolutely not something that you want to use as an only tool to base your decision on. Well, now we've been through a lot of background of the intrinsic value of a company and a stock. And as I said in the beginning, it's being used quite heavily, quite frequently by analysts. So it has some value, that's for sure. And I think what the biggest value is of the intrinsic value, that it gives a pretty rough indication what the future might look like. What I like about the fact of calculating the intrinsic value is that you look at the numbers, you look at the fundamentals, you really try to make sense out of the numbers. You play around a little bit, etc. What also I really hope that you learned while looking at the theory around the intrinsic value is that the intrinsic value will increase when the profit grows. So there is really a very strong correlation between the growth of your earnings and your free cash flow and the growth of the intrinsic value. And I'll probably dedicate a video later where really I will even demonstrate the correlation between stock prices and the profit growth. Now, also, if it's used conservatively, as we did, you're going for worst case scenarios here, it helps to eliminate some weaker companies from the list of candidates. If you're looking at candidates in very rapidly using the intrinsic value screening, you can quite rapidly say, hey, this is a potential good candidate or this is not. But it's definitely not the only parameter I would base my decisions on. There are also quite some weaknesses to the intrinsic value calculation. I think the biggest one is that, as you've seen in the examples, it's based on many assumptions. You make assumptions for the discount rate, you make assumptions for the growth, you make assumptions for the free cash flow evolution. You make so many assumptions that it's very hard to rely on the results of the intrinsic value. Also, one thing, and that what we notice, the terminal value is almost always the biggest factor in, or the most influential factor in your present value. We saw, I think for Procter & Gamble, it was about 52%, or could be 57%. It's typically much higher than 50%. So that means that, and I'm just having 10 years of explicit evaluations, right? So the terminal value is by far the most influential factor and yet the least accurate. So don't spend too much time trying to make a scientific approach around the intrinsic value calculation. It does not pay off. I mean, it's just going to give you an indication, but it will never be accurate. And the last thing I think that is also obvious here, no one can predict the market. It can take years before that the market and the stock price will converge to the intrinsic value. Maybe it will never converge to the intrinsic value. It will maybe stay around, and so don't make it a scientific approach. So my conclusion when it comes to intrinsic value, so it really should be part of your basic toolkit. I think it's quite important. And by the way, most of the analysts use an intrinsic value calculation. But it's good to use it with constant factors so you can compare different companies to each other. So you can use it, but don't blindly make any decisions on the output of these. So you can use it to analyze, to make worst case scenarios, best case scenarios, likely scenarios, but it's a pure evaluating tool, and use it as such as well. So that would be my conclusion. So if you like this video, please give me a thumbs up. Please add any comment. I'm more than interested to hear whatever you have to say. I hope it was useful. And also any suggestions. I mean, I'm okay to talk more about, as I said, the correlation between intrinsic value evolution or stock market evolution and growth evolution. There are so many things we can talk about. So let me know any suggestions. I will be happy to discuss this next time. Thank you very much, and see you later. Cheers.